TV18 on YouTube. Okay, welcome back. You got markets up 114. So, well, we're going and going how? Nicely, and almost a trending kind of recovery from the day's lowest point. Gurmeet, of course, is with us, but Jigar Mistry is also joining us from Buoyant Capital. Jigar, good afternoon. Good to have you as well. And Gurmeet, thanks for waiting. Jigar, same question to you, what I asked Gurmeet. In this, 8-9% pullback from the highs, what has started to look attractive and what have you bought, if you can share with us?
Yes, good afternoon, Prashant. Season's greetings to you and your team. In the pullback, I think, I don't think, Prashant, we have pulled back enough yet. The last time we were discussing, we said that essentially over the past few months, the feeling has been that, this 30-40% annualized returns has become the norm. It's the new reality. If I take a slightly longer term period, say a 5-year or a 10-year rolling return, the average might surprise you. For the Nifty, the earnings growth has been 12% and index growth has been 14%. For the small cap, those respective numbers are 10 and 12%. The past 5 years, index growth has been 22% and it's been even stronger over the past 2 years. 50% of the total mutual fund investors have come only in the past 4 years, so post-COVID, and they've not really seen what a 20% sort of drawdown looks like. So essentially, we need to see whether sort of how the behavioral aspects change if we see a drawdown to that effect, number one. Number two, if your earnings per share and share price growth has always been correlated, and given that they have become dislocated over the past 2 years or so, because earnings have not been over the past 1 year, if I look at large caps, earnings growth has been 22%, index growth has been 31%. And for the small caps, those respective numbers are 17 and 50%. This is just before the current fall. So if they've become dislocated, then it stands to reason that either the earnings will go up quite dramatically, or the share prices need to correct for that relationship to be maintained. Now, given the slew of results that we are seeing in this season so far, it doesn't appear like the earnings is going to go up in a big way, which also sort of then implies that there's some correction that might be imminent, more so from a behavioral standpoint, that that proverbial towel has to be thrown in before we start seeing the next leg of growth, in my opinion.
So you're sitting on cash till then, or you continue to invest, Jigar?
Not beyond the point cash, Prashant, because see, what tends to happen is that the family offices we run money for largely will be managing cash at their end. So we're running a beta of the portfolio that is significantly below 1. Almost 40% of our fund is in BFSI. So those are sort of historically considered a reasonably low beta event. Cash doesn't really, in our opinion, help. Sitting on a large amount of cash, historically, you have had 0.2% of the days driving 60% of the index performance. If you miss the top 10 trading days in 20 years, your returns would have been lower by almost 60%. And missing 25 days, your returns would have been lower by 84%. So cash doesn't really help. Managing the beta of the portfolio certainly does. Post-COVID, we are almost at 1.4 times the beta. A few months back, we are down to 0.6, 0.7.
You said 45% of your portfolio is in BFSI. Any
40.
exposure? 40%. Okay. Any exposure to companies with MFIs where the stress has gone up considerably? Because I remember in the past you talking about Satin Credit Care. So do you own any such stocks, and what would you do with them now?
Not anymore, Rima, because see, these are sort of within the financials. You're looking at number of cycles playing out, right? So you have the sort of at the first end, your interest rate cycles, then NIM cycles, then asset quality cycles, and then the valuation cycle. So as a sector, these are considered cyclicals. Within that, the MFI is sort of the mother of all cycles, right? Because you might remember how SKS, the original sort of the father of MFI in India, from 2000 to 2010, they grew so well. And then in 2011, in the AP crisis, the amount they had to write down was 2 times the combined profitability of those 10 years. So clearly there are businesses which you buy very cheap and sell cheap. In our opinion, MFI constitutes that. It's been a long time that we have sort of liquidated exposure to all of our MFIs, given that they had run up quite well. So yeah, no longer own any MFI players. What we do own are very large banks, largest sort of PSU bank as well, and the large private sector banks.
Hi Jigar, happy Dhanteras and good to see you in after a while. Jigar, what about these new issues that have come off late? You know, Ola Electric, you have Vare as well. Did you all participate in any of them? Ola Electric, you know, someone who got it on early on, they should have rather booked out. The stock is almost half from the top. Your take?
Hi Nigel, happy Dhanteras to you as well. No, we don't sort of own any of them. The sort of, the broad-based thinking going into most initial public offerings is that, the people selling have a disproportionate knowledge of the business compared to the people who come in new to buy those. So unless there is a very, very compelling case, which given the markets were when these companies were getting listed, was not really conducive to sort of people like us who would want to see a few years of listed entities history, also want to see, how the managements react when the first signs of trouble arise. No, we were not owning any of those names which you mentioned. I don't think Vare is listed just yet, but no, we're not even in the anchor positions for those names so far.
All right, Jigar, stay with us.
Jigar, talk about one or two ideas. You're a bottom-up guy, so and we've not talked stocks. There must be stuff which is looking attractive, Jigar. With the disclaimer that it's not a, it's not a. We're not asking viewers to buy. They should do their own research, but share some thoughts.
Right, Prashant. So I think a few businesses that did we discuss last time around. See, pharmaceuticals as a space and allied activities look reasonably good. Within that, I think the business we haven't yet spoken about is a business called Blue Jet. Now, as you said, pinch of salt, fistful of salt. People should, view and decide. Our fund is exposed to that. But that's sort of one of those businesses where, you have them sort of catering. What they manufacture is contrast media. And they're working with 4 of the top 5 industry players in terms of how they deliver this contrast media. There has been a reasonable expansion sort of that has been planned out, and they're going about executing them fairly well. So that's one sort of business that we have liked, and that's something that we find interesting. Besides that, it's not from what it appears, it's not, Prashant, something where there's so much like a stock-driven, stock-specific call rather than what you should own and should not be owning from a sectoral standpoint. So a lot of our time these days has been going into selecting what sectors we should get positioned into and what are the sectors that you would want to sort of avoid in a big way.
All right, we'll leave it there, and good to get some ideas, Jigar. Thanks for sharing that. With, of course, the disclaimer, as I mentioned. Thank you for joining us, Jigar. Gurmeet, appreciate you being with us here as well. Season's greetings to both of you, once again, from all of us here at CNBC TV18. 140 points, so we're actually almost at the day's highest level. We'll take a quick commercial break here. We're going to come back with, some more ideas with our experts on the other side. Stay tuned.